Welcome to the Female Finance Collective podcast, where we encourage women to have open and honest conversations about all things money.
I'm Jen, and I struggled for many years with debt and feeling financially overwhelmed, so I know how frustrating it can be. Now I'm passionate about helping women confidently take control of their personal finances.
And I'm Mary Lee. As a financial planner, I've had the privilege of working with hundreds of women who've transformed their financial lives. I'm excited to share my insights to help you on your financial journey.
Hey, I'm Sybil. I built my dream life traveling the world and creating financial freedom on a teacher's salary. Now I help women take charge of their money and burn brighter in life.
Let's start the money conversation. Welcome to Female Finance Collective. We are very excited to have you here. And what we're going to talk about today is something that I get really passionate about because as we've been talking about debt over the last several weeks, I just feel that credit cards are something we don't talk enough about in just general in society. Everybody has them. We have credit card ads in our face all the time on TV or on our phones. There are pop-ups everywhere, but we don't really ever talk about how credit cards work, how they impact our credit, how we end up paying so much more over time when we use them. And I think casually we mentioned, I'm using we like the collective, not just us as the Female Finance Collective, but like the whole society, right? Our
The
community.
people.
Right, the people, exactly. We say like, oh, you should pay it off, but sometimes we can't, right? Sometimes there's something going on and we've relied on the credit card for an emergency, or we just we're like, I just really want this thing and I can't afford it, so I'm just going to use it. But we don't often think about the impact or break down exactly what that means and how it's impacting us long term. So today we're going to do our best to explain like how credit cards actually work, explain how much something ends up costing if you only pay the minimum payment or take a long time to pay it off. And we're going to try to explain APR, which is annual percentage rate, which is how credit cards are charged. It's a little bit wordy and almost easier to read, but we're going to do our best to explain how that works without taking too much of your time. So, Sybil, let's dive in with like understanding interest. Like, how does that work? What kind of interest do credit cards have? Like, give us the scoop on that.
Yeah, let's just start with what is interest. And, that's ultimately how credit cards make their money. The reason all these companies are in our face 24/7 is because they want us to not pay our full balance and therefore pay interest, right? So interest rates are a percentage, and those percentages on credit cards are very high. They're typically between 15% at the low end for credit cards these
Really
days,
low.
all the way up to 30%. I don't know about you, Jen, but my credit cards are really on the higher end, and I have an excellent credit score. So credit, borrowing money from credit cards can be very expensive if you don't pay it off and you're only especially making the minimum payment. That's when it really gets like so expensive that it's not something you want to do because you can't overcome it necessarily. And so the way your credit cards work and decide on the interest rates for you kind of depends on a couple of things. Some credit cards, they have set ranges as well, right? And this can be influenced by what you actually get offered for your credit card by your credit score. Okay. And your credit score takes into account things like on-time payments. So do you pay before or on the due date each month? It takes into your credit history is taken into account. What are the other elements of credit? We'll be talking more about credit scores in the future. And I think we have some past podcasts about how a credit score is determined as
I
well.
think so too.
But also how much money you're borrowing each month. Okay, and what you need to know is that interest rates are multiplied usually daily on credit cards. And when you pay interest on your credit card, it becomes a part of the sum that you're due, and it gets interest on top of that interest. So it's compounding on top of the interest. It's kind of confusing, but
When
it's
they
not like a
charge,
one-time payment.
that's right. When they charge you interest, they're adding it to your balance. And so then you're just
Yes.
paying interest on that, right? So that it is confusing to think about because it feels like they should be separate, but that interest just gets added into your balance. And then next time they calculate interest, that's factored in.
Yeah, exactly. Exactly.
So,
So some other elements are like that you have minimum payments. Are you going to pay partial? You're going to pay in full, right? Things like that. And that influences how much interest is put onto your card each month or each day in this case.
right. So the annual percentage, I feel you explained it. That's exactly what they do. They like calculate it daily and then it gets added up because it's like calculated and then divided by the year because it's the annual, it's the amount you would pay. So you're not paying 24% of your balance every single day. You're paying 24% of your balance over a year, and then they divide it by the day and then add it up. And it's complicated. So if how we're explaining it and you're just like, I do not get it, I Google it. Google how do you simply explain APR, or use Chat GPT and ask it, can you give me a simple explanation of APR, annual percentage rate? And you can read it. And I think seeing it is a little bit easier to understand than how we're describing it. But basically, they're just going to take that balance, they're going to calculate your percentage, divide it by the days, and then add that for the month, right? So I did a little math earlier. NerdWallet, we all know I love NerdWallet. They have a credit card interest calculator. It's just right on a page. It was very easy for me to find. You put in your balance, you put in the percentage rate that your credit card currently charges, and it will tell you how much interest you're going to earn, like accrue that month, how much they're going to add. So a $3,500 balance with a 24% credit was adding about $70 a month. Now, you talked about minimum payments, Sybil. Minimum payments on a credit card are between 1 and 3%. So 1% of a $3,500 balance is $35.
Not
So
very much.
not very much. So if I'm only paying the minimum payment of $35, but my interest added was about 70, I'm only paying half of the interest that was added, and I'm paying zero of the items that I've charged on my credit card. So I think that's the part that we kind of forget, right? And that's why I think it was so important that you explained how the interest is added into your balance, because you're not even paying off the balance. You're just paying off like half the interest. So if we only ever pay that minimum payment, we're paying forever.
It's only growing. You're never cutting it down because the next month you're paying more interest and you're only paying half the interest again,
Right.
or
So
even less each month.
yeah, exactly. So this is why this, like, I hope this isn't feeling too overwhelming. We're just trying to like give you some information so that we can then kind of get to the point of this, is that every time you charge something and don't pay it off, you're carrying that balance for a really long time, unless you make an effort to really start to pay the balance piece down and not just the interest piece. So, for example, to just keep it really simple, we can talk about like $100 sweater, or a pair of shoes, or whatever it is that you would tend to buy. Maybe it's a meal out, right? And I think we would just be like, $100, that's not that much. No big deal. I'll just put it on my credit card, right? But if your credit card has 29% interest, and let's say you only take 6 months to pay that off, and you like make an effort to pay a little bit of the actual balance every month, you're still going to pay an extra $16 on that sweater, right? Or that meal. But hit him with the hard truth, Sybil. What's the real truth about that?
The real truth about paying 116 instead of 100.
Yeah.
Well, I mean, I don't know what you're thinking exactly, but that the opportunity's lost. Like you could have had that extra $16 to buy something on top of your sweater. Number one. Number two, our brains don't really process it in that way necessarily, right? We thought we paid $100 for that sweater, but really we paid 116 by the time we had paid it off, right? And unless you're like really and in this situation, I guess it's easy. You're probably not just buying that $100 sweater.
That's exactly what I was thinking. And I was like, will she think the same thing as me? If you're very quickly and easily charging $100 sweater, you're charging all kinds of other stuff too.
True. Right. Exactly.
Right? And you're not thinking, you're still thinking every time, oh, it's just $100 sweater. Oh, it's just $25 for lunch. Oh, these shoes are on sale. They're only $50. And next thing you know, you've charged all of that. And then it's not just $16 for the sweater over 6 months. Now it's going to take you 2 years to pay it off because it's far more charges on there, right? And that means the interest of $16 for 6 months is actually like 4 times that because you've carried it for 2 years instead of 6 months. And you've paid that interest on every single one of those items that you've charged. So I hope that this is making sense and that we're explaining it in a clear way. But I also hope that it's making you a little bit confused because that is the truth of what credit cards are doing, right? They are confusing you into thinking, oh, it's only this much interest on this item. Oh, I only have to pay this 1% minimum payment. Oh, it's just so easy to tap and swipe and what I mean, I haven't swiped my card in a while now, right? We just tap it, sometimes even our phones, and it's so quick and easy. But they want us to feel confused by that and to think, oh, no big deal. But the truth is, it is a really big deal. And if you're using your credit card, I use a credit card, Sybil uses credit cards, but we only charge what we can afford to pay off at the end of that month.
Every single month.
Every single month. So we're not carrying a balance. So credit cards are great for certain things, right? Earning airline miles, hotel points, cash back. There's all kinds of benefits to them, but it's only a benefit if you're paying them off.
You certainly don't get 29% in those benefits.
No. No.
You get one, I have a credit card that's 1.5% cash back and I'm like, woohoo, it's the highest one, besides like a category one that gives you 5% or something. But if I'm not paying it off full every month, I am losing big time on those points or those miles or that cash back. And we want, like Jen said, we really want to almost alarm you, like, stop overspending on credit cards because you are paying way more than you know it if you're not paying in full every single month. And the credit card companies try to give us more and more money, right? They try to raise our limits. So now you can borrow this much, right? Why do they want you to borrow more money? To pay more interest. This is how credit card companies and banks make money. Is the interest.
Right. So if you pay for your $100 sweater at Banana Republic, then the credit card company sends Banana Republic $100, and then you need to send the $100 that they sort of loaned you for the sweater back to them, or else they're going to start charging you the interest, right? And that exactly what Sybil said is how they make the money. They're like making you a mini loan. If you start thinking about your credit card as a loan every single time you tap it or swipe, that shifts your thinking a little bit. It is a loan. And then it like helps smooth out the confusion a little bit, right? Because before everyone, they're like these little mini loans that add up, and then you've got interest on every single one, and it feels so small when it's just $16. But when it's $16 on every single thing, all those mini loans add up, and then it's $70 a month, and they're not asking for very much in return.
Yeah, and I just had the thought, like, if we bought that $100 sweater, we're assuming that $100 includes the tax you paid at that store. So you're actually paying interest on tax too.
100%.
I hadn't even thought about that. So let's switch gears to think about like how can we like kind of get out of this vicious cycle if we're in a cycle of spending on credit card and only paying the minimum or not paying the full balance each month. Um, One of the first things that comes to mind is what you mentioned a little bit earlier, Jen. We are really in a cashless society now. So yes, there's cash apps like Venmo and Zelle and things like that where it's direct from your bank account. They're like debit cards, right? So it's cash. But the credit cards are a huge player in this. And like you said, we just tap, they're memorized in our browsers or in our password protector or wherever. Like we can buy now without even putting anything in on Amazon because it's already all in there, right? One button, you can make that purchase for that $100 sweater. So we really now need to try harder than ever, especially the young people that only know this kind of cashless society, right? Um, the first thing I would say is that we need to pause before spending. And we talk about this a lot on these podcasts and in our community because it's easy to say, but it's hard to do, right? That pause before spending or that 24-hour rule of waiting for 24 hours before you actually purchase it is one of the best evidence-based ways to spend less. And when you spend less, you don't have to worry about the interest as much because you're not overspending, right? Or you're not buying things that you don't necessarily need or even frankly want, because we just get so normalized and we think this thing will make us happier. And really, the research shows that oftentimes it won't. It's the experiences that we want to spend on that make us happier. And so taking that pause, and if you can even pause up to 24, 72 hours, all the better. That's a one way to really help yourself not get into the situation where you're paying $116 for a $100 sweater.
That's right. And I think too, we also rely on credit cards to pay for things that we genuinely cannot afford. Right? And that is a hard truth. And I don't want to hurt your feelings, people, but I had to have that conversation with myself too. You might really want this, but you cannot afford it. And however unfair that seems and however like crappy that feels, sometimes that's true.
Yeah.
And so that's another thing to kind of come to reality with. And does that mean that you need to budget your money better? Does that mean that you need to look at a different job? Like, what does that mean? I don't know. It means something different for everybody. For some of us, we're making fine money. We just are spending way more than we make, and we need to like rein it in and realize, oh, I could actually spend a lot less and still feel fine. Right?
There's
You
also
don't even.
lifestyle creep, right?
Yes.
Everyone else is doing it. I'm entitled, or I feel like I should do it too, right? And everyone else, I mean, the amount of people in the United States that have credit on credit cards paying this high interest is enormous. I don't know what it is specifically right now, but that person that has that item that you think you want to very likely is paying interest on it.
Right.
Unfortunately,
Yeah.
it's just like normal. And so your bodies and brains think, I can do it too. I need that too, right? It'll be okay. I can pay the extra for it. I'll deal with that later,
That's
right?
right. But it is stressful. Carrying a
Mhm.
balance that you can't afford to pay off is stressful. It's overwhelming. And even if it's not something that's in your face all the time, it lives there. It just like hovers there, that like stress every time you have to pay for something, every time the bill arrives and you see whether it's coming on paper or coming in your email, that bill is still there. It's still a little ping like, don't forget about me. And that can really feel overwhelming over time. So I think the biggest thing that Sybil and I want you to take away from this is to like educate yourself about how credit cards actually work.
Yep.
Because that is, don't get tricked by, oh, it's so easy. I just pay for this and then I just have to pay them this like tiny amount every month and then it's no big deal. Because when it comes down to you wanting to buy a new car, wanting to put away money for your future, like saving for the future, wanting to save money to purchase a house or anything like that, it's going to impact your credit score and it will impact the money you have available freed up in your budget, because every time you're making a payment on these loans, these credit cards, you're taking money away from your monthly budget to pay for stuff that you bought in the past. It's not even current. And I think the one thing that I want to say is we do understand that sometimes emergencies come up. Sometimes you don't have an emergency fund saved and you've got to rely on that credit card. We understand that. And that happens. Sometimes it's happened to all of us. But what we want to caution you away from is utilize that credit card. If you have to carry a balance, let it be something that was an emergency, and then really focus on getting that paid off so that you have that available credit if something does come up, instead of being like, oh, if I wouldn't have charged all those small things, I don't even have room on my card for this like kind of big emergency.
Yeah, make a plan. We can link it below, a snowball debt calculator. Put it in there and decide how many months you're going to pay it off. What monthly payments can you make on it when you're in that emergency situation, so it doesn't get out of control. One of the biggest things, like Jen said, is educating yourself. And the next biggest thing is start to do it and make plans. Stick to them, find your people. Tell us what's going on. We'll hold you accountable. We would love to. But those small purchases, they really add up quickly. And so this awareness by educating yourself and by making plans is powerful. And you can do it. We know you can. And what we would say is the number one thing we want you to do and take away from this conversation today is to start tracking those purchases, because again, that helps you with awareness. You start to see the numbers. You start to see, did that sweater really, was it worth 116? I'm not sure. I don't even wear it anymore, right? But in the moment you felt like you needed it, and that's okay. Give yourself grace. But learn from it, and don't make that $100 sweater again in the future. And one powerful way to do that is to track your purchases and see those numbers. Watch those numbers grow. Use that nerd wallet calculator. Use a debt calculator. Play with the numbers. You will be very motivated to not pay 29% interest month after month. So we hope this conversation's been helpful, maybe a little alarming, but sometimes we need a wake-up call. And today is the best day to get started. We always say that here in the Female Finance Collective. The past is the past. The future is the future. Be present right now. What can you do right now to improve your situation and start living the life you want to live, right? And our finances are a huge part of that. So thank you so much for listening. Be sure to like and follow us on Instagram, YouTube. We're on all of your favorite podcast platforms you're listening right now. And we'll see you next week.